One of the biggest reasons why traders fail is because they trade days that they shouldn't. Not every day is a trading day, even if the market's open. Range days, news days, low volume days, they all look tradable if you don't know what to look for. Believe it or not, most losses don't come from bad execution, come from simply just trading the wrong environment. So in this video, I'm going to try break down for you exactly how I decide if a day is worth trading or not before I even look for any setups. So if you don't know much about my trading, I trade two pairs specifically, which is NASDAQ and ES. You can see the price action is just on a consistent uprise, meaning getting involved in the market is so much easier than trading something like Forex, which over the long run is designed to go sideways. So first off, I only trade the NASDAQ. If you trade Forex and you're thinking of clicking off this video because I trade futures, I'd highly recommend sticking around because this might actually open your eyes to futures trading, because identifying days whether to trade or not is actually super simple. So something to note, and this is the first step, identifying the asset's correlation. So what I mean by this is the NASDAQ and ES are supposed to move in sync, meaning if NQ on the left is moving like this, ES should also be moving the same. They should look identical. But when they're out of sync, this is where we want to stay away from the market. Now let's find an example. So if we take a look at this time frame here, we're on an hourly time frame. You'll notice that this high on NQ is still intact. And if we check ES, whoa, hold on a second. That's the same high. See how they're not moving in correlation? ES has already taken this high. NQ hasn't. I'm staying away. I'm not trading. And the issue with traders is they go, well, ES is the stronger pair, so maybe I should look for buys here. Because I could also argue the fact, well, actually, NQ's the weaker pair, so ES might go down with it. Do you see my point? So when the market is out of sync, we do not trade these days. Now, for an example of a day that does look good when the markets are in sync, this is what it looks like. So if we switch between NQ and ES, you can actually see there's not that much of a difference. They look pretty much identical, right? But what I have noticed is we've created a bearish divergence. Now, because this asset is designed to go up in the long run, it's pretty easy to frame up for a trade when it comes to sweeping lows and going higher. So you can see here that we've swept all of this low resistance liquidity. We've created a divergence. We also have very clear targets such as Asia high, and we also have this internal high here as well as targets. So right now, this looks really good for a long position. And if we go to NQ, it's the exact same story. You can see here, we have a clear target, we have a clear target, and we have the divergence. And then I can use things such as deviation levels to tell me where to get involved in price. You can see here that we've tapped into deviation to 2.5. On a 50-minute time frame, we've created a 15-minute gap. We'll see if we get an inversion of this, which we have done, and then we can just enter stop loss below the gap, and then we can target the targets. And if you see here, you'll see that ES and NQ are moving very much in sync right now, which is good. So if you play this out, and if we look at ES, you'll see that they're moving in sync. Okay, here's another example of what would put me off a trading day. Let me explain. Let me ask you a question. Does this look like high probability conditions to trade? Yes or no? I'll give you a few seconds. My answer is no. We are what you call, at the moment, stuck in a range. And if you don't know what this is, let me explain. We can grab the date and price range tool from the nearest high, which is this high here, to the low. And this is what you call a trading range. And if we use our date and price range tool for this, we mark it out from the high to the low, you will notice that we've been stuck in this range for 1, 2, and coming up to 3 days. First off, you can expect a lot less volume. And look at it. There's barely any volume in this market right now. And if you just zoom out on the higher time frames and actually observe what is going on, you'll soon be able to understand actually, yeah, probably just going to stay away from the market. And so many people struggle with this. Now, even if these markets are moving in sync, these are less higher probability conditions. Because this is a bearish range, we would anticipate price to come into discount, which is above this middle line here, and then look for that continuation lower. But as you can see, price has come up to it, had a bit of a sell-off, come back up, had a bit of a sell-off, come back up, and ultimately it's going sideways. And if you're getting caught up in these conditions and you're taking trades and then it's hitting your stop loss, then going to your take profit, this is probably why, because you're trading conditions that are very choppy. Now, here's a good one for the team that trade the Asia sweep model. So take a look here. We know if we sweep Asia high, Asia low is going to be our target. You can see here that we're already getting some really nice momentum, and it looks like price may go for the Asia low. You can also see that we've tapped into deviation 2 to 2.5, but currently there is no divergence between these two assets. As you can see here on Asia high, there's no divergence, meaning we can't get involved in a trade. If there is no divergence, there is no trade. Now take a look at these two assets here. As you can see, currently there's a divergence. Can you spot that? I'll give you a few seconds. So the divergence actually lies between this high and this high. Notice how NQ has failed to take this high here, but ES actually has taken this high. A divergence signifies a market reversal, and it's a discrepancy between two correlated assets. So when I see this, I am allowed to get involved in a trade. Now ask the question, where's the divergence here? I'll give you a few seconds. There isn't one. Notice how these markets are perfectly in sync. So when there's no divergence, I'm not allowed to get involved in a trade. It is a must. So let's ask the question again. Is this going to be a tradable model for the day? No. Why? Because there's no divergence. So before I get on to the next topic in the video, I want to give a shout out to today's sponsor, Prop Firm Match, the leading prop firm comparison platform. If you're not using Prop Firm Match in 2026, what are you doing? They have everything, whether you trade futures or even Forex. It tells you everything about every single firm, rated from high to low. See here, funding pips, we've got every single review left on their platform, how long they've been in operation, and the best part is they have promo codes for nearly every single one of these prop firms. Just use code MATCH at checkout for 20% off most prop firms. Now, futures traders a lot of the time will get stuck on some rules. All we need to do is click on the platform of our choice and we can see everything about the prop firm. Leverage, consistency rules, firm rules, and the best part, payout policies. And if I'm still skeptical about a prop firm, I can just come to the review section and find everything about the prop firm. Rules, customer care, user friendliness, payout process, you name it, it's on this website. So whether you trade futures or Forex, if you're not using Prop Firm Match, I couldn't recommend this enough because this has saved me more times than not. Check the link in the description where you can find out more about Prop Firm Match, and you can use code MATCH at checkout with most prop firms for up to 80% off. Now let's get back to the video. Now let's take a look at this example here. This is the final one of the day. Notice how we swept Asia low. Asia high would be our target. But you're wrong. Asia has actually closed bearish, meaning there's an 80% chance that London will also continue going lower. Now, a lot of people will see this and go, oh, but this looks really good. Oh, but look, we also have an inverse fair value gap here. They target the Asia high and they instantly get cooked. And then what they're doing is they're hunting the next fair value gap. They're going, oh, well, we've pushed even deeper into deviation 2 to 2.5. Oh, it just kept going lower. Oh, okay, now we're coming into deviation -4. Look, we had the inverse fair value gap here. Oh yeah, this is a good idea to long it. So they'll long it. And this is the problem I see so many traders make with the Asia sweep model, is they fail to understand the probabilities that come with it. When Asia closes bearish, there's an 80% chance that London will also continue bearish. Now, let's say we got something like this, where as you can see at the moment, Asia looks pretty good. Then Asia session decides to do something like this. Asia has now closed bullish. And then what happens in London is we get a sweep of Asia high. And everyone's screaming, oh my God, Asia lows the target. But we understand that if Asia closes bullish, there's an 80% chance that London will also continue bullish, meaning we do not trade. Now ask yourself this question, did Asia close bullish or bearish? Well, we can use the date and price range tool for this. We can draw it out, and as you can see, as soon as London is opened, it's pretty much opened at the midpoint of Asia, meaning that Asia hasn't closed bullish or bearish. This meaning if we get a sweep, now we've got the sweep, we can find our manipulation leg from wick to wick. You can see that price is already trading within deviation 2 to 2.5. We come to ES, you'll actually notice there's a divergence on this low. And then if you come onto a higher time frame, you'll notice there's a fair value gap here. Wait for price to close above it. Now you've got the closure. Now you can enter and you can target the Asia high. And that is exactly what I want to see from the Asia sweep model. Accumulation from Asia, manipulation lower from London session, and then for the rest of the day, clear distribution to the upside. So now we're just going to do one quick test. Question 1, is this tradable? I'll give you a few seconds. No. Why? Because the markets are completely out of sync. Test number 2, is this tradable? I'll give you a few seconds. No. Reason being is we're stuck inside of a range, which usually leads to less volume in the market, more choppy price action, and much harder to get on side with it. Question 2, is this tradable? I'll give you a couple of seconds. Yes, it is. The reason being is the markets are overall moving in sync, as you can see. But price has created a divergence between this level and this level. And this signifies what? a market reversal. So yes, this is a good time to trade. We must have a divergence for us to get involved in a trade. Now here's a tricky one. Is this tradable? Yes, and let me explain why. Asia closed bullish. We never got the sweep of Asia high. We actually got a sweep of Asia low. And we understand because Asia closed bullish, there's an 80% chance that London will also close bullish. And if we play price out, that is no mere coincidence. So if Asia closes bullish, Asia highs still intact and we sweep the low, this is very good conditions to trade. And final one, is this tradable? Yes or no? I'll give you a few seconds. No. Why? Asia high was swept. Asia closed bullish. There's an 80% chance that London will also close bullish. Meaning, if we're trying to get in for a short, it's going to be very unlikely it's going to play in our favor. And if we play price out, you'll see exactly that. And I have some experience trading the NASDAQ. I know how this asset moves. And don't get me wrong, I've only been trading 2 years, but I've been mentored by someone who's been trading for 13 years, who's taught me everything that I've taught you in today's video, but even more in depth. And this is the reason why I've had such good trading results this year, simply from following the same plan and staying patient when the market conditions do not align. So if you want to learn how I got these results last year, and you want to further your understanding with knowing when to play aggressive and when to do nothing, which is the reason why I am here today. I'm full-time trading, I'm getting some amazing results, and I'm printing on a consistent basis. Check the link in my bio where you can find the link to the mentorship. And if you're still skeptical, well, here are all the trades that I took in 2025, alongside some others trading my New York model with all of this data. Now, I hope you guys have found this video helpful. And as always, if you have any questions, please don't hesitate to leave them down below. I'll get back to them in as much detail as I possibly can. I'll leave my social media links down below as well, where you can check out what I get up to on a daily basis. I always post live trade updates on there as well. And I'll also leave a link down below for the mentorship. So that's all from me today. Thanks so much for watching, guys, and I look forward to seeing you in the next one. You take care.